So here's a wild thought. Can a math sequence, something figured out way back in the 12th century, actually predict the crazy, chaotic swings of today's financial markets? That's the big mystery behind Fibonacci Retracement, a tool that millions of traders swear by. Is it some kind of market magic, or is something else entirely going on? Okay, let's get into it. Here's the game plan for this explainer. First, we're going to look at where these numbers even come from, and trust me, the answer is surprising. Then we'll nail down what Fibonacci retracement actually is. After that, we'll see how traders use it day to day. Then comes the big debate. Does it actually work, or is it just a massive case of groupthink? And finally, we'll wrap it all up with a clear, balanced takeaway.
You know, to really understand this tool, we've got to go way, way back. We're talking 12th century Italy to meet the guy who kicked this whole thing off. And he wasn't looking at stocks, he was looking at rabbits.
This is Leonardo Bonacci, better known to the world as Fibonacci. Now, he was a brilliant mathematician who brought this special sequence of numbers to the West. And here's where it gets kind of weird. This exact pattern seems to be hardwired into nature itself. You see it in the branching of trees, the petals on a flower, even the spiral of a galaxy.
The sequence itself couldn't be easier to start. It literally just begins with two numbers, 0 and 1. And from there, all you do is add the last two numbers to get the next one in line. So 0 plus 1 gets you 1.
And you just keep that pattern going forever. 1 plus 1 is 2, 1 plus 2 is 3, 2 plus 3 is 5, and on it goes into infinity. Now the sequence itself is cool, right? But for traders, the real magic isn't in the numbers themselves. Nope, it's in the relationship between them.
Okay, so how in the world do we get from a mathematical pattern found in nature to a practical tool on a trading screen? Well, it all boils down to a few very specific percentages. Let's break them down.
All right, this right here is the secret sauce. If you take any number in the sequence, let's say 55, and you divide it by the very next number, which is 89, you get something amazing. The answer is always, and I mean always, hovering right around 0.618.
And this number, 61.8%, has a famous name, the golden ratio. For traders who use this stuff, this is the absolute holy grail. It's the cornerstone of the whole system.
So that brings us to the official definition. Fibonacci retracement is basically a way to find potential support and resistance levels on a chart. The whole idea rests on a simple observation. Markets almost never move in a straight line. After a big run-up or a big drop, the price tends to pull back or retrace a bit before, hopefully, continuing on its original path. So what traders do is they draw these key percentage levels right onto their charts. You've got the 23.6, the 38.2, and of course the big one, 61.8. Now, you'll also see 50% on there all the time. It's not technically a Fibonacci number, but it marks the halfway point of a price move, so it's a huge psychological barrier that everyone watches. Each one of these lines is seen as a potential turning point.
Okay, theory's done. But what does this actually look like in the heat of the moment? Let's get practical and see how a trader uses these levels to figure out a market's bounce versus trying to predict its next big move.
I love this analogy. Think about dropping a basketball. Retracement is like measuring how high the ball bounces back up. It's a reaction to being dropped, right? Extension, on the other hand, is like throwing that ball up in the air and trying to predict exactly where it's going to land. One looks backward, the other tries to look forward.
So in the real world, a trader starts by finding a big, obvious price move on their chart. Let's say a stock took a nosedive. They'll find the peak where it all started, we'll call that point A, and the bottom where it finally stopped falling, point B.
And then they wait. They watch as the price starts to creep back up. What they're looking for is to see if that bounce runs out of steam right at one of those key Fibonacci levels, like our old friend, the 61.8% line. If the price hits that line and stalls, that could be their signal, a sign the bounce is over and the original downtrend is about to restart. So when you put it all together, traders are using these levels for three main jobs. 1, to find good spots to enter a trade. 2, to figure out strategic places to put their stop losses to control their risk. And 3, to use the extension levels to set price targets for taking profits. It's a full-fledged system for managing a trade.
So we know what it is, we know how it's supposed to work, but that brings us to the elephant in the room, the million-dollar question at the very center of this whole thing. I mean, seriously, is there any real, measurable, predictive power in these numbers that come from nature? Or is it something else entirely?
This is where things get really interesting.
See, the biggest argument against Fibonacci is this idea of a self-fulfilling prophecy. The theory goes that the tool doesn't work because of some mystical connection to the market. It works simply because a ton of people believe it works, and they all act on the exact same signals at the exact same time.
Let's just game this out for a second. Picture one trader sitting at their desk. They see the price bounce up and smack right into that 61.8% retracement level. They think, aha, resistance, and they hit the sell button.
But here's the thing. That trader isn't alone. Not by a long shot. There are thousands, maybe even millions, of other traders staring at the same chart using the same tool. They all see the price hit that 61.8% line, and they all decide to sell too.
And what happens when a huge crowd of people all hit sell at the same moment? Well, that massive wave of selling pressure overwhelms the buyers, and it forces the price down. The prediction came true, not because of some ancient code, but because a critical mass of people acted in a way that made it come true.
So, where does that leave us? How are we supposed to think about a tool whose power might come more from mass psychology than from pure mathematics? All right, let's boil this all down. Here's what you really need to remember. First, at its core, Fibonacci is a tool for flagging potential areas of interest on a chart. That's it. Second, its effectiveness might just be a result of that self-fulfilling prophecy we talked about. It's just that popular. And this is really important. Many extensive backtests have shown that these levels have no more predictive power than any random line you could draw. Which leads to the golden rule. Never, ever use this tool by itself. It has to be combined with other forms of analysis.
And that leaves us with one final, kind of mind-bending question that's bigger than just trading. In a system like the market, which is driven by human belief and collective action, if enough people believe a pattern is real, does their belief alone actually make it so? It's a fascinating look at where math, money, and the human mind all collide.